Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Hope you had a good New Year's break. Hope you had a good holiday and Happy New Year. Welcome to 2025. We are taking a look at Nike this morning. This stock is down 27% in the past 5 years. When people talk about brands, when people talk about things that can't miss, sometimes they talk about Disney, sometimes they talk about Nike. Both of those have missed. I think brands are less important than they used to be. And that is seen by the struggles of these two companies, Nike especially, down 27% in the past 5 years during a time when the market has been going up and up and up and up and up. You were much better off investing in the S&P 500 than Nike. Even after you account for dividends, your return is still negative here. And they just had an earnings released latter part of December, and those earnings were mediocre, better than the market expected. We'll talk about that in a second, but still mediocre. And I think that's really what's driving the stock performance here. The results here have been really mediocre in the last couple of years. They had a really nice boost here during the pandemic. You probably should have sold out when this was trading at a 2% free cash flow yield in 2021, $250 billion market cap, driven off the fact that they grew about 19% in fiscal year 2021. The market maybe expected that to continue, that free money timeline of 2020 and 2021, where people bought sneakers, where people were reselling sneakers at double the price, where everything was flying off the shelves. Maybe it was going to continue, but surprise, it didn't, and the stock started to fall and fall and fall. John Donahue, the prior CEO who was just replaced a couple of months ago, didn't do a lot of great stuff, and that's shown in the long-term performance since he joined in 2019. He kind of moved away from the wholesale partnerships, focused on direct to consumer sales, thought that they could make more margins and didn't need those wholesale partnerships. Maybe he was right for a brief second, but then he ended up being wrong as other competitors took that shelf space from Dick's or whomever, their retail partners, and suddenly On Running was a big brand in the United States. Suddenly Hoka was a big brand in the United States. Suddenly Brooks was gaining market share and other brands were gaining market share. And that was a problem for Nike because less and less people were getting their stuff directly from them, and that's seen in the latest release. And less people were seeing their product on store shelves where they kind of see it, they can try it on, and if they like it, maybe then they'll go to your stores, to Nike.com, and buy it, but that certainly hasn't been the case lately. Again, this is not a dying company by any means. I think people look at this performance and say Nike's dead, but it's not the case at all. This isn't dissimilar to what happened to Meta a couple of years ago, but Nike isn't really trading anywhere close to those valuations where Meta was at $100. Again, Nike's not dead. It's just wounded right now, and it's interesting to see what this new CEO will do to fix that. The other problem that happened under Nike, under this older CEO, was that their innovation kind of fell off a cliff, and they didn't take advantage of a lot of the opportunities that they had. You know, one example that comes to mind is Caitlin Clark, the WNBA player, who's been one of the most popular women's basketball players for quite some time. Nike had an NIL deal with her in college in 2022. They didn't really do much with that. She was kind of breaking records, doing all sorts of stuff, being very popular before even being drafted in the WNBA. So my thought was, once she's drafted in the WNBA, they will have a shoe ready for her right away when she starts in the WNBA. Spoiler alert, they did not. She started breaking records in the WNBA, became one of the most popular rookies in the league. Anytime her game was on TV, it broke WNBA television records. That league was suddenly interesting simply because of her. And yet, no Caitlin Clark shoe. Even now, they still plan to release it in 2025. But my thought, if I were a Nike investor, is that is a missed opportunity. Why are we not taking advantage of such a popular player? How long does it take to come up with a signature shoe? Why are you so sloppy as a company? And I think that's really what the new CEO is trying to fix. He's trying to focus back on innovation, focus back on some of the areas that they lost market share in, like running, like lifestyle, and really focus on a new slate of shoes that is going to come out in 2025 and try to make the company better. So as you look at Nike, as you look at the valuation, again, the P ratio of 22x on a lagging 12-month basis doesn't look too bad. But then if you look at the next 12 months, it's 38x. It's kind of expensive on a historical basis. We'll look at their free cash flow yields is sort of trading in that 3% range on a next 12-month basis, which is also, you know, kind of in line with what they've historically traded in, but maybe on the slight side of expensive. We'll look at valuations in a second. But again, Nike is not dead. Yes, there have been some missteps, but Nike still has 16.4% global footwear market share, down from 17.1% in 2022. It's still the biggest player. It still has the ability to recover if they can, if they want to. That means that, hey, Adidas is there as well, but most of these other players that I mentioned, whether it's Hoka, whether it's On Running, whether it's New Balance or Brooks or whatever, those are like 1 to 3% market share companies. And that potentially means that, hey, those companies have a lot of growth ahead of them. But it also potentially means that if Nike really does something, they put their massive budget to work and clamps down, they can push back on those companies pretty easily. Because if you think about their size, that means they have a massive budget to one, sign a bunch of athletes, kind of an athletic company. You know, this is sportswear. Kids like it. When I asked my nephew what he wanted for Christmas, he wanted Nike tech wear. This is still a brand that's in the forefront of the minds of the younger generation. The brand awareness of this company is as high as it's ever been, and it's still one of the most popular brands in the world, in the United States. Again, I see it less and less in my friend group, in my work group. So maybe that's a bit of a sign, a bit of a worrying sign for shareholders, because when I go out, I see more On Running, I see more Hokas, and I see less Nikes than I ever used to before. But Nike can get back to where it was because it has that size, it has that budget. And by that budget, I mean Nike spends 4 billion plus in marketing expenses every single year. And if they do a good job with marketing is a very big thing when it comes to brands, when it comes to brand awareness. I don't think they've done an amazing job in the last couple of years, but that can certainly change under a new CEO that has a better, more focused understanding of what this brand is about. And if he does, then that $4 billion can be very useful in sort of gaining market share again and sort of growing again after they do this 1 year reset that they're doing right now. We'll talk about that in a second. And $4 billion is a lot of money. If you think about it, On Running is a $2 billion revenue business. So Nike spends more money on advertising than On Running has in revenue as a whole. Same with like Hoka. Hoka is maybe a $2 to $3 billion revenue shoe business, if that. I don't remember the numbers, but it's something in that range. So the ad budget is there. They're going to need it, and they're going to need to make good use of it to really recover, because the earnings themselves are not very good. If you look at their second quarter earnings, down 8% over last year. Direct revenues down 13%. Again, you're not seeing it in stores. Maybe you're not really looking at Nike anymore and you're trying to move somewhere else. And it's sometimes kind of difficult to get back users that you lose. If you move to a new shoe brand, maybe that's your shoe brand forever. I know there's still a lot of people that love Nike, but now there's a lot of people that love On Running. Now there's a lot of people that love Hoka. That's a bit of a concern, and wholesale revenue is down only about 3%. The main problem, and the reason the stock is down as much as it is since this latter part of December when the earnings were released, is that the guidance for Q3 wasn't very good either. I think the market expected something similar to this, but they're getting low double-digit negatives for Q3, which is negative 10, negative 11, negative 12, whatever it may be. A lot of that is probably going to be driven by Nike Direct, as they're really putting a lot of stuff on sale over there. They're trying to get rid of old inventory in order to move in with the new CEO, Elliot Hill, who's started as an intern in Nike in 1980. He has an idea of what Nike was doing poorly, and hopefully he can kind of get back to the Nike of 2010 to 2020, where Nike was really shooting in all cylinders, growing really quickly, had the right styles, had the right athletes, and had a focused approach to what they were doing. Certainly, they're going to focus more on upper end items as well, kind of get lower inventory to meet the maybe slightly lower demand, but at slightly higher prices. I would think that would be my strategy if I were CEO of a company like this one. I think that's where they're going to head, because obviously 2024 results, 2025 fiscal year rather, are not going to be very amazing. So as we look at the valuation, again, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. So as we look at the valuation here on the next 12-month basis, Margins are going to contract. They already talked about how margins are down 350 basis points between Q2 and Q3 because they're putting a lot of stuff on sale. They're clearing out inventories for some of the exciting new stuff that's going to come in. Again, it's innovation is coming back. Can Nike get back to what it used to be before John Donahue? That's really going to be key if you're an investor in Nike. And I'm certainly thinking about it because this is a great brand, a great company, but apparel can be a difficult thing to invest in. However, if you're going to invest in something, invest in a company that you know has stood the test of time, maybe is struggling a little bit right now, but has the budget and the wherewithal and potentially the leadership to recover. So as you look at the 3% free cash flow yield on a next 12-month basis, compare that to the 6% free cash flow yield on a lagging 12-month basis, big gap. Again, I think this is a bit overstated. I've seen a lot of videos use this as a, wow, what an amazing deal, but there's a lot of boosts from change in inventories, from accounts payable. So that's kind of an abnormal number. I think the realistic long-term margins are going to hit here is about 10%, which is what I have priced out over here. They do pay a dividend. I expect that to go up about 7% every single year, which is what I've priced out here. They buy back about $2 to $4 billion worth of shares every single year. So when you think about that, that's against a $109 billion market cap, anywhere from 2 to 3% return, plus the dividend 5%, plus any growth you're going to get beyond this year, which is going to see no growth, is kind of the return you're going to be baking in. So what I've done here is I have the negative 10% growth for 2025 fiscal year with a 7.2% margin. Then I'm kind of expecting a return to normalcy, about 5% growth for the next couple of years, down to 4% in the latter year here, and margins that are improving by about 50 basis points, starting at 8.5% up to that 10% margin mark that I'm hitting by 2029. So again, you're not seeing a ton of growth. The expectation for me here isn't that you're going to blow it out the water because this was a $4.8 billion free cash flow company in 2023. It's going to be a $5.5 billion free cash flow company in 2029. So obviously, I'm not assuming crazy things here. You can make your own assumptions within the spreadsheet. Hit file, make a copy to use this spreadsheet if you'd like. 40% of their money, their free cash flow, is going to go towards buybacks, the rest towards dividends. They're not really an acquirer of companies or anything like that. They're basically paying a dividend, growing it, buying back shares with the rest of the money, and keeping their balance sheet healthy because they do not have a ton of debt, only about $2.3 billion in net debt. That's again capital leases plus long-term debt minus cash. When I look at valuation, historically this company has been kind of in that 3.3% free cash flow yield range. I'm being a bit more conservative here. I'm putting 50% in 5%, 50% in 4% for an overall 4.5% free cash flow yield. Again, 3.3% free cash flow yield is great when you're growing, but now you're shrinking at negative 10%. You have some uncertainty. You have a lot of competitors. I think I have to be a bit more conservative here. At today's prices, that kind of gives me a 6.7% expected return inclusive of dividends, some of that from buyback yield, some of that from dividend yields, and some of that from return. You can certainly be a bit more conservative or a bit more aggressive. If you want to go to 5%, you get a 4.7% total return. If you want to go to 4% free cash flow yield, you get an 8.6% total return. And then if you want to get closer to 3%, you kind of think this is going to eventually get to where it's historically been. You're going to be in that 14% total return. So in my mind, the range is kind of in that 4 to 14% total return range, which isn't that bad when you consider a company like Nike, a marquee company like Nike. When you consider that during the 2008 recession, they were still net income positive. They kind of grew during that recession. So even if a recession is ahead for the United States and you're worried about that, I think Nike might still do okay. They probably won't suddenly fall into negative free cash flow territory or anything like that. So that's something that gives you a level of safety for a company like Nike, and why I'd probably be a bit more comfortable taking a total return, target return that's, a bit below that 10% one that I target usually. With an 8% target return, gets you to about 10% with dividends, gets me to a fair value of about $61 at these assumptions. And again, these are probably a bit conservative. If you want to change them, feel free. You can kind of play around with this. Let's say you want to give it 100% to a 4% free cash flow yield. It gets you to a fair value of about $68. I feel like today's prices aren't outrageous. Like if you're buying this at $73, I see why you are. There's certainly some upside from these numbers if they can get their free cash flow margins up faster, if they can go above 10%, closer to 10.5 to 11, if they can start growing faster than 5%, in the next couple of years. And if the market gets them closer to that 3.3% free cash flow yield that they've historically been priced at, the $73 price point certainly makes sense. But for me, I'm not really a guy who invests in apparel too much. I'm more of a tech investor, more of a growth investor. Right now, this is not a growth stock by any means. It's shrinking by 10%. Obviously, it's not a growth stock. So for me to buy this, I'd have to have a bit more margin of safety. And I'm sort of building that in with this free cash flow yield valuation with these assumptions. And if this stock keeps falling a bit, because the momentum here isn't amazing. Obviously, it's down about $5 since the earnings. If it keeps falling into the 60s, mid to low 60s, I might initiate a position in Nike. But for now, not really something I'm interested in, because the valuation just isn't all that exciting for what's ahead for this company in the next year or two. Because I don't think this is a company that's suddenly going to shoot up to $90. Like Q3 probably won't have a massive impact on this company unless the earnings suddenly come in at minus 5% growth instead of negative 12% growth, because that really shows a quicker turnaround than the new CEO is projecting. And if that's the case, then buying today obviously makes sense. But for me, it seems like this could be a longer turnaround play that, the marketing budgets have to take some time to sort of churn through, that some of these new styles that they're releasing, some of these new shoes that they're releasing have to wind through the marketplace, that the inventory sell down has to happen. And that's going to take a couple of quarters. And while that happens, this stock might sort of meander in this $60 to $80 range. And if it meanders closer to 60, I think I'll start a position. But until that happens, I think I'll hold off. Although I can see why people would be interested in this at $73. Like Bill Ackman started a position not too long ago, sort of in that like high 70s range. And I get why. It's Nike. I'm not sure that Nike should have traded at $180, 2 years ago at a 2% free cash flow yield. But, Nike trading close to 3%, which is sort of in that low 70s range, is sort of where it's historically traded. But where it's historically traded has also produced a market losing return. So maybe it's historically traded a bit too richly. And if that's the case, that maybe it needs to come down a bit more to get to a area where the long-term return is actually market beating, because I don't think it is right now. So that's my take on it. Let me know what you think. Am I wrong about Nike? Have I missed anything? Is there anything else I should be looking at here? Do you own Nike? And if you do, let me know down below why you like it. Otherwise, thanks for watching. If you have any ideas about what I should do a video on next, let me know. I do plan to make more videos in 2025, although I always say that and I get lazy. Thanks for watching. Have a good day, and bye.